Welcome to Earnings Central. In this video, we'll break down Lockheed Martin's second quarter fiscal 2025 earnings. We'll cover key financial performance metrics and dig into insights from the earnings call. All right, let's go. Starting with top-line revenue, the original estimate for Q2 was $18.57 billion. The company actually reported revenue of $18.16 billion, missing expectations by 2.2%. This quarterly revenue marked a 0.2% increase compared to the $18.12 billion reported in the same quarter last year. Moving to adjusted earnings per share, the original estimate for Q2 was $6.52. The company actually reported an EPS of $1.46, falling well short of expectations by 77.6%. This result also reflects a 79.5% decrease compared to the $7.11 per share reported in the same quarter last year. Now let's dive into some additional performance metrics highlighted during the earnings call. Lockheed took $1.8 billion in total program charges during the quarter. This wasn't just one problem, it was three separate legacy programs hitting major roadblocks. The largest hit was a $950 million charge on a classified aeronautics program at Skunk Works, plus $570 million on the Canadian Maritime Helicopter Program and $95 million on the Turkish Utility Helicopter Program due to sanctions complications. The cash flow story tells a mixed tale. Free cash flow usage hit $150 million in Q2, which was largely driven by timing issues rather than fundamental problems. The delayed F-35 Lot 18-19 contract award created a $600 million working capital headwind, and the company faced about $100 million in tariff impacts. However, management expects most of these timing issues to resolve in the second half. Here's what gives investors confidence for the future. That massive $167 billion backlog provides a solid growth foundation. This represents years of contracted work, and management expects to set a new backlog record by year-end with several major awards coming in the second half, including F-35 contracts, JSS MRASM procurement, and PAC-3 production deals. Looking ahead, 2026 free cash flow is expected around $6 billion, down from the current year's $6.60 to $6.80 billion range. This decline factors in continued cash usage from the troubled programs, about $500 million from a classified aeronautics program, and $200 to $250 million from the MFC classified program. However, the company gets some relief from new tax legislation providing $400 to $600 million in benefits. On the legal front, the $4.6 billion IRS tax dispute remains under appeal. This stems from the IRS challenging Lockheed's tax accounting method changes related to revenue recognition rules. The company is confident in their position since the IRS initially approved their approach, and management has reserved just $100 million for potential interest, signaling they expect a much more favorable outcome. Despite these challenges, the commitment to at least $6 billion in annual shareholder returns remains intact. The company returned $1.3 billion to shareholders in Q2 through dividends and buybacks, and management reaffirmed this will continue as a cornerstone of their capital allocation strategy. Now let's shift focus to some of the key insights and takeaways from the earnings call. The quarter's most compelling narrative came from real combat operations. F-35 and F-22 aircraft led recent military operations against Iran, providing the air dominance and stealth capabilities needed for bombers to reach hardened nuclear sites. This wasn't just a successful mission, it was validation of Lockheed's advanced systems operating undetected in heavily defended airspace. This combat success ties directly into the Golden Dome defense system, representing a major opportunity. This proposed Homeland Defense Initiative would create multiple layers of missile defense, and Lockheed positions itself as the mission integrator with ready-now capabilities across THAAD, PAC-3, and Aegis systems. While contracts haven't been awarded yet, the architecture discussions with the government are already underway. The missile defense surge is evident in procurement requests. PAC-3 production is being requested to quadruple by the U.S. Army, and for the first time, the Navy wants to purchase PAC-3 missiles for Aegis integration. This represents years of internal Lockheed investment finally paying off with customer adoption across multiple services. Hypersonics programs are gaining priority status in the defense budget. The Air-Launched Rapid Response Weapon, ARRW, received nearly $400 million in the fiscal 2026 budget request, marking America's first proven hypersonic weapon capable of aircraft launch. The Navy's Conventional Prompt Strike missile also had a successful end-to-end flight test, demonstrating the maturity of Lockheed's hypersonic portfolio. However, not all news was positive. 3 legacy programs face major challenges that required the massive charges. The classified aeronautics program experienced design integration and test challenges that proved more costly and time-consuming than expected. The Canadian helicopter program needs enhanced capabilities and extended fleet life, while Turkish sanctions complicated that helicopter contract. Management has implemented enhanced oversight and is pursuing contract restructuring discussions. Despite program challenges, strong international F-35 demand continues with new orders from the UK, Belgium, and expressed interest from Denmark. With 311 F-35s still in backlog, and Lot 19 adding about 15 more aircraft, production flexibility remains strong even as domestic procurement faces budget pressure. Lockheed Martin's Q2 represents an inflection point, clearing out legacy program issues while positioning for a new era of defense spending. The $1.8 billion in charges were painful but necessary to reset expectations on troubled contracts. Meanwhile, combat-proven performance is driving unprecedented demand for missile defense and advanced systems. That wraps up our recap of Lockheed Martin's second quarter fiscal 2025 earnings. If you found this recap helpful and want to stay on top of more earnings reports from other companies, don't forget to subscribe. We've got plenty more quick and easy breakdowns coming your way from Earnings Central.